Hi, Sean McCracken here with Hotel News Now, speaking to Mit Shah from Noble Investment Group. Mit, seems like you guys are pretty active right off the start of the year with a couple acquisitions. What are your general expectations for 2020, and what's really driving business for you guys at this point?
Well, first of all, Sean, thank you for having me again. I think our expectations are probably no different than what we're seeing across the broader economy. You'll have the public REITs, all kind of announce, their earnings forecasts, for this year. Our expectation is going to be probably in line, which is the overall macro is going to be somewhere between 0 and 2% RevPAR growth for kind of most of the country. So our focus at Noble has always been on a very micro, market by market strategy. As you kind of look at the landscape of all lodging companies, we've always tried to say, let us go and be on the side where we can go into an individual market, kind of target where do we want to be. And so whether it's downtown Denver or downtown Nashville or Tampa or Midtown Atlanta or markets like South Lake Union, Seattle. So for us, we believe that those markets will exhibit a higher trajectory than the overall U.S. macro, and so the investments that you mentioned early on are in keeping with that. Charleston, South Carolina, Yale University, downtown Denver. I think that we've all done over the last month or so. So in keeping of kind of just our long-term strategy, the interesting part of I think just our business in general, and as you know, we focus exclusively on the select service extended stay side, so called the transient demand side. As you track, Smith Travel only started tracking transient demand in 2003 outside of total demand. If you actually look at a slide that tracks transient demand over GDP, what you find is something that's very interesting in that when GDP peaks, transient demand peaks higher. And when GDP troughs a little bit, transient demand is much shallower, right? Yeah. So while there's no great expectation that transient demand is going to be significant, it does feel like, that there's an opportunity if you in picking these kinds of markets we believe are going to exhibit more growth in the macro with the stability of that kind of demand that we can absorb, continued increase of operating costs that, we know is, impacting the business.
So are you concerned at all about where we're at in the cycle, or is that kind of conversation kind of just run its course at this point?
Yeah, look, I think everybody can prognosticate in their own way where they believe economically. I mean, our thesis really is kind of simple. We're developing hotels in urban locations that we believe outside of strong RevPAR growth, so call it 1 to 2% RevPAR growth, we can deliver a double-digit unleveraged yield by our second year of operation. Okay, so that's a very simple thesis, right? You get to a 10 on leverage, with leverage, you're in the high teens. So that's kind of part A. And then when we're buying, if we're buying between a 7 and 8 cap, in these kind of $100 RevPAR and above markets, and by the way, there's 3,000 of those kinds of hotels that exist, in our category throughout the U.S., over $100 billion of value, and you put 50% debt on it, which is what we do in our Core Plus strategy. So buying a 7.5, put 4% debt on it. I mean, you're creating the ability to have some pretty strong cash on cash yields, and we hold these assets for 10 years. So back to your question about concern about point of the cycle. If we take a long-term 10-year view, of real estate and just kind of across all categories. Over 10 years, that's where the specialists win, right? If you're trying to get in and out over 3 to 5 years, right, you're going to have lots of different economic factors that come into place and a lot of things that just outside your control. But over a 10-year period, we believe that, as a specialist, we can truly control our outcomes. So even if we had a 10% blip to RevPAR, let's just assume that happened at some point in time.
Everybody hopes it doesn't happen.
Right? But if it did,
if it did,
use the math for just a moment, right? Buy to 7.5 and, put 50% leverage on, and you can still take that 10% hit to RevPAR and still not only cover debt, but cover a very high single-digit kind of return on the investment. And so for us, what we look at is, and when we kind of take a look at our stress tests around that, it's just a function of making sure that we feel like we're in the right markets, in the right street corner, in the right locations where we can add kind of operational enhancements and also some profitability matrix. So while we're all concerned about kind of the things that we don't know economically, and it certainly does feel like it's going to be very muted, 0%, by the way, 0% RevPAR growth is negative EBITDA growth, and maybe even 2% RevPAR growth is flat to negative as well. And so I think our strategy continues to be, how do we focus on the right markets but at those kinds of metrics that give us the ability to still control our own destiny, as we've done for 27 years. I mean, this is not our first rodeo. As I look back on it, we started the business in 1993, and the Russian financial crisis was in the fall of 1998. Arne Sorensen tells a great story. He took over as CFO for Marriott literally the week the ruble collapsed, right? And it had this massive impact on Marriott stocks. So, and then the dot-com bust of 2000, 2001, the tragedy of 9/11, the great financial crisis. All of these things happened where it was completely out of our control and the like. So having gone through all of those different types of cycles, developed through them, acquired through them, et cetera, I think what we've always kind of leaned on was, let's try to figure out how to be the best specialist, pick the right markets, and then when we have to grind through, we'll grind through, and do it at a low leverage point.
And the assumption has to be that it's not a if, but when. So sitting there and driving yourself crazy about what that might be is not going to accomplish anything. Well,
so outside of the market considerations, what I just mentioned, and the structure of the premium branded select service and extended stay, the two big points here are the length of time, 10 years, and the low leverage. The combination of those two, we believe, continues to give us, a great ability to execute the strategy, even, taking into consideration what impacts might happen.